Hi, and welcome, and thank you for tuning in to our market update here, first one we have in 2025. The reason why we wanted to do this video was primarily we've been having some conversations with you, clients, and other people, and there's been a lot of fear shared with us about what's going on with the markets and how, are we okay? Will we be okay? And so we wanted to kind of check in and with our thoughts and maybe add some perspective as to what's going on with not just politically, but with the markets and whatnot. We want to kind of keep this video relatively short, maybe to 20 minutes or so. So we're going to kind of move pretty fast here and try to address your fears and give you some perspective on what might be happening. Okay. So with today's agenda, we're going to hit four basic subjects here. We're going to talk about the current market trends, what's happening now, and what we might get out of that, what's going on. The big question is, what is Trump doing with all of his policy changes and whatnot? And then we want to kind of look at it from a headwinds and tailwinds, like is there positive and what are the negatives in what's happening? And then what are we doing from an investment standpoint for client accounts? And we'll end with that. Okay. Mark, is there anything you want to add before we move on?
I don't think so. I think you covered it well. So
Okay,
let's go ahead
let's
and
do it.
go to the first slide. You want to cover that, Dan?
Yeah, sure. I'll talk about this. So I think this is kind of an obvious thing. Right now, we've shown this video before, and it's been in the fear quadrant for a while, but now it's kind of moved down to this extreme fear. And this is kind of the feedback we're getting back from people. A lot of worried people out there about their investments. What are we going to do? I think that can be done about this. So this is kind of setting the mindset of investors, and it's not just our clients. I think it's all investors. But let me just stop here for real quickly and just kind of generally speaking, we've looked at client accounts and portfolios, and for clients most of our clients are in like a 50-50 portfolio, and what we're seeing is that if you're in a 50-50 portfolio, your accounts is probably a little up or maybe just a little bit down. So regardless of the volatility that we've seen in the last 2.5 months, say, returns have gone toe to toe with the volatility. And basically, most clients are in a really good position. The diversification and allocation of our portfolios is working. There's some bright spots that are kind of help bolstering or helping us weather this volatility that we've been expecting.
Yeah, and I've actually got some statistics. So,
Yeah,
well, I think one of the key things, as Dan said, is diversification is working, and
yes,
which hasn't been necessarily the case over the last couple of years because it was all Magnificent Seven, tech, growth stocks
yeah,
and diversification was not
and
working.
U.S. stock market dominated as well.
Exactly. And so one of our key mantras here and philosophies is to reduce to outperform in bad markets or volatile stock markets and such, and then try to perform as best we can to the upside, but certainly try to reduce losses.
Right.
And we did that in 2022, which was the last volatile market where the market was down 20%. And we took losses, much less than what the markets did. And so we want that to continue, and it has continued this year. So basically, the stats are, U.S. stocks are down overall. This is all stocks down 5.04% as
Yeah.
of yesterday, I believe. And international, every other stock, so call it international stocks, Japan, Europe,
Emerging markets.
emerging
Yeah.
markets, they're up 6.27%. So we have about 35% in non-US stocks. We have value stocks, which have been up. And so primarily it's been the growth stocks, tech stocks, and small cap stocks, which have been beaten up. We also have our bonds are up, all our alternative
Yeah.
investments are up. And so overall, I mean, we were looking, as Dan said, maybe up 0.5% to down 0.5%, somewhere around that range, plus or minus, depending on Some clients have different portfolios with some individual stocks and such, so they may be slightly different. So anyway, with that said, I'll cover this just real quick because,
Yeah.
but basically, as Dan said, our last webinar, we were expecting, a rally afterward as uncertainty lifted. And then typically after a election, the post-election year, as you can see here, this yellow part it's typical to have choppiness, through the first part of the month as they're, the year as they're rolling out their agendas. Okay, again, uncertainty. Now, granted, we're fully aware that Trump's agenda is
Supercharged.
more ambitious than most. So anyway, what's happened in the first couple 3 months is normal. And I saw this today. This just I just printed this today. Stocks have bottomed on March 12th, the past 20 years. Unfortunately, we were trying to shoot this yesterday, but we couldn't get it out. Yesterday was March 12th. Today's March 13th. So as you can see, again, typically you have weakness in the beginning part and then followed by up markets. Again, we're not predicting, we're not saying that's going to happen for a fact with all that's going on, but it is some context.
The takeaway from this chart is that if we're following history, is that yesterday we may have bottomed, but of course we have to say historical returns is no prediction of future returns. But yeah, it's a remarkable statistic that's been going on for 20 years.
Yeah. I wish we could say yesterday bottom because today's the 13th and the markets got pretty beat up today. So, so anyway, it's exact. This also puts in perspective. Dan, you want to talk about this?
Yeah, let's talk about this. So, markets are down, and there's a lot. Again, and we're going to use this word a lot: uncertainty, or at least I'm going to use it a lot. So it's kind of a growing. The theme is going to go through this. So uncertainty creates a lot of instability in stock markets. Stock markets is not like uncertainty for sure. However, even though we're kind of going through this and it makes us nervous and stokes old fears, this is part of the course for as an investment or as an investor. You have to take the down markets with the good markets, and it's quite healthy to have a down market, whether it's a correction of like the negative 10%, and we always have recessions, which would be a stock market down more than 20%, say. But this is part of normal course, and it's part of a healthy investment environment, and it actually provides entry into the market and reinvestment back into the market where returns are demonstrably higher and more positive after a downturn like this. So this is just a reminder for everybody out there that, hey, this is not new. We've been through this before, and it's actually quite healthy and part of a normal investment cycle.
Well, I just want to emphasize, make sure that this chart. So basically, the right column is the total return for the year. The left column where it says DD, I think that's down, drawdown. I think that is. Yeah. That is what from a peak during the year to a correction, you have these drawdowns, and as you can see, if you have under a 10% drawdown in any given year, that's rare. That's more rare than it is than not. So hopefully this is what is occurring right now, is another drawdown inside of a good year. But then again, the last couple of years have been really good. So anyway, just that's the price of admission to be an equity investor and to get 10 plus returns, 10% plus returns in stock market. Yeah. Okay, so this topic is going to get kind of interesting. So this is
the primary question on people's mind. What kind of boils down to is what is going on? What is he doing?
I was going to put, what in the bleep is Trump doing? That's what a lot of people are saying. So
yeah.
Sure. So let me take this real quick, Dan.
Yeah,
so the tariffs, okay. So as you can see right here, well, let me see if I can get my little chart here. I can't get my real point here. Let's see here. Well, anyway, so the the tweet at the bottom was from this morning or yesterday. And this is the latest, Trump bombastic comments. Hey, Europe, if you're going to retaliate to my tariff and try to put 50% on
Or whiskey.
whiskey and different things, I'm going to tariff you 200%. So it's like someone in no limit poker that is basically going all in when they sense weakness. Now, we're fully aware that Trump is over the top. However, if you one thing about Trump is he, as inconsistent and volatile as he might seem, he does have a track record. He goes
Part of-
in he goes in huge and negotiates back to where he wants to go. Okay.
yeah.
So
The
there's a
typical Trump playbook.
yeah. So there's a couple things that I think people should hopefully take solace in. Is one thing is with all the Doge stuff and some of these things that Dan mentioned, the three branches of government have proven once again to work. Okay, because some of these things have been blocked in the courts, some heading all the way to the Supreme Court to stop some of these initiatives, and so that's one thing. So those who are worried about him completely becoming a dictator and
Yeah.
whatnot, we still have three branches of government.
There's some check and balance. Correct.
Yep. The second thing that we have checks and balances is the markets. Okay, so if he overplays his hand and the
Markets crash.
financial markets, if they crash, they will cause backtracking of policies that aren't working. Okay, but basically his whole tariff thing. So this is, in my opinion, from what I understand, the case for tariffs. His
Yeah.
case is
Yeah.
one is to boost domestic manufacturing, bring back manufacturing jobs, which also does, if you remember post-COVID, where all the masks and supplies were all made in China and we couldn't get any. It also brings back important supply chains of things so that we have more control over it, which will help with national security and pandemics and things like that.
That might be the supply chain. The supply chain issue would be more of a longer term
Yeah, for sure.
positive out of this. Yeah.
Yeah. Reduce trade deficits is an objective, and also to increase revenue from non-tax related stuff, so that he can impose his tax cuts and say, hey, it's neutral. Is this going to work? I have no idea. The case against tariffs is, which you're hearing in the media, is higher consumer prices, inflation, because
It's passed down to the buyer.
it will get passed on to the consumer. The massive, retaliation risk, which we're seeing from other countries, and then also temporary supply chain disruptions, as they have to get the manufacturing in place, and it takes a while. Okay,
Takes time. Yeah.
so I'm of the opinion that his strategy is just go big or go home, but he is not expecting to keep these huge tariffs in place, because he did this in 2018. He tariffed China. By the way, the Biden administration kept those the entire time. He tariffed Canada, and Mexico, but he gave them waivers for most of the important products, and so I expect something like that. So.
One other thing to add on about the tariffs of his first term as well. Like you said, they didn't go away. They're still there. But remarkably, what happens when you have competition and capitalism, I think, in effect, is they find ways around it. So that can also be a side effect of what's happening too.
Yeah.
That eventually we'll figure a way around it.
Yeah.
And
Okay.
yeah.
Okay, let's move on for just timing purposes. So
Yeah.
this one is oh shoot, I hope let's see here. Sorry about that. This is the meaty topic. This is just a quick chart of historic tariffs, and then you can see on the right side the proposed tariffs,
Yeah,
which is more like
projected.
which is like outlandish, like the 1930s thing. Okay, this is the meaty topic for us today. So let's talk about the headwinds. I think we'll just kind of tag team this, Dan.
You want to take the first bullet and I'll take the next?
Sure.
One
So
or
we've
two?
got government debt. We've got long-term debt. This is the $30 trillion, and then we've got deficits, which is also we're increasing our debt. So one of the big things that is not talked about much, um, but is probably one of the biggest issues facing the Trump administration and the Treasury Secretary Bessent, is of the $30 trillion in debt, about 30% of it is rolling over this year.
Coming
So
due.
$7 trillion. And so basically what happens is that debt comes due. They either pay it off, which they can't because we don't have any because we're in massive debt, or you have to refinance into new treasuries. Okay. And the challenge is $7 trillion is you have your typical China finances, Japan, Europe, and so on and so forth.
Foreign
But
investors. Yeah.
but you're going to have a reluctance to be continuing buying treasuries if you were them because of all the trade disputes and such. Even if things were all rosy, um, the remaining debt is going to have to be picked up by us, the consumers, banks, pension funds, and
Mutual
um, and
funds. Yeah.
mutual fund, and frankly, I think there is the potential where they can't, all of us combined can't buy enough of the debt, where there's a potential for a failed auction. Now, what happens when a failed auction? Well, they go and do another auction at some point down the road, and they have to charge higher interest rates. They have to pay higher interest to entice people to buy it, which, since we're in debt, will cost us billions and billions more in interest payments each year. Okay. Or what is more likely to happen is the Federal Reserve will step in and buy that debt. And this is what is known as monetizing the debt, i.e., printing money, just like we've been doing. And because we're the reserve currency, everything is mostly in US dollars. We can just push a keystroke on the computer and appear we can just print money at the click of a keystroke. If that happens and the Fed has to come in and buy it, there's two things that can happen. Is that can keep interest rates low if the market seems in a calm state, or um, it can be viewed as we're taking on more debt, that the U.S. Treasuries are riskier, and the long-term bonds may sell off in as a result of that. And if that were the case, and long-term bonds, 30-year treasuries, but the 10-year treasury is kind of the benchmark, which mortgage rates are based on, and a lot of different things. And so if yields spike in those because people view it as higher risk, that hurts real estate. It will hurt stocks, and
Their interest rates
could
sensitive.
be, yeah, very interest rate sensitive. So that is something to watch very, very closely. Um,
Just to
now,
add on to that, and maybe drip over into the next bullet point, is that these things are coming due where interest rates are higher than they were when they were originally issued. So they're having to refinance these things at a higher rate, which means more debt service has to be paid. So we got a higher debt service, and if there should be a failure in uh, the Treasury issuance, that will only drive rates even higher. So it's kind of a catch 22, or just kind of a rolling effect there, ripple effect there, which all of this kind of leads to, it looks like, at least temporarily, or if not for a longer term, greater deficits. Deficit spending isn't something new, and it's not a Republican, or it's not a Democrat issue. It's been going on for 20 plus years. We went into a war with Afghanistan, didn't raise taxes at that time. Obama and Biden, they all had, and Trump, all had deficit spending. So these increasing deficits become harder to finance, especially with the background of the government having to refinance the existing debt and then adding more onto it as well. So
Yep.
it has a ripple effect that kind of spreads out there, affecting government treasuries.
Yep.
Uh, Immigration effect. We may have a slide in this, but just real. Do we have a slide in this, Mark? I don't recall.
Yeah, well,
Yeah,
yeah, we do,
we'll talk about
a
that in a second.
couple other things. The deficits, okay, as they're trying to reduce deficits, that's what Doge is trying to do.
Yeah,
Is That's not necessarily inflate. That's that could, with all the layoffs, basically, so you have
right.
the
Yeah,
potential of this government debt stuff. They're trying to reduce government debt, which can lead to higher unemployment. So there's all these weird things happening that are counterbalancing, and you don't really know exactly what's going to play out. Another thing before the immigration effect is the corporate debt wall. There's a
yeah,
whole bunch of debt. We don't have any slides on this, but there is a whole bunch of corporate debt that was refinanced during COVID that is now rolling over in 25, 26, 27, significant amount.
yeah,
And so if that rolls over at higher interest rates, if rates go up, that's going to be a real drag on the economy as well.
yeah.
And of course, we have deficits.
Yeah.
Regarding the immigration thing, Dan, I'll let you cover that. There's that slide.
Okay. So the immigration part of this was that we've had some very positive employment reporting here in the last few years. A lot of that has been fueled by the increase in immigration, and not only that. I don't want to make it too complicated, but if you peel back the layers, you kind of find out, well, even though we've added jobs, those jobs aren't necessarily full-time jobs. A lot of them, most of them, the jobs added were part-time jobs.
Actually,
And
all of them
all of them.
on a
Okay.
net effect.
Okay. Net effect was all of them. Okay. And then the other kind of thing that complicates this, or seems like, why would they even do that? It seems uh, ridiculous, is that if so you have one part-time job and you need a full-time job, you go out and get a second part-time job. Well, the way they count those, even though you have two part-time jobs, they count that as two full-time jobs, right? I mean, that doesn't make any sense, but that's what they're doing. So it kind of artificially boosts these employment numbers, or at least the full employment numbers, artificially. However, as we're kind of projecting out there in this chart, so that's one issue, is that there's kind of some weirdness in how they're calculating the unemployment and the number of jobs. However, if immigration is decreasing going forward, then that will have an effect on the job rate, and then the added effect of a declining populace, natural growth from births, less deaths. That is also shrinking. So we're kind of entering a phase here of maybe a shrinking employment pool, which results in less tax revenue, less Social Security revenue, and the effects of that kind of thing. So that's another rippling effect. Next slide. All right.
Okay.
Tailwinds. So is there some positive things we can maybe pull out of this? And we think we've come up with a few, and what some of the maybe the plan is underneath. So artificial intelligence. I'll just take this one real quick. This has been in the news a lot the last couple of years. I think we're kind of seeing the effect of how it affects our work. You may be seeing the effect of it in your work, but we're probably just kind of barely scratching the surface of leveraging this from a efficiency standpoint. We could be on the cusp of a real new, I hate to use this word, paradigm, but we could really be just on the cusp of how this technology can propel and maybe grow the economy, or at least make things more efficient, faster, less expensive, much in the way that the integration of the PC and the microchip have been affected our economy through the 90s, that kind of thing. And obviously another one would be robotics as well. Is there anything I'm missing on that in artificial AI or
yeah, I mean okay, so people like Mark Andreessen and some of the significant tech investors talk at length about how well positioned the United States is
Yeah.
from an AI perspective and technological revolutions. And this chart on the right is it just kind of blew my mind when I came across it. It's talking about computing power by countries. And so I don't even know what a teraflop is. Well, I guess one teraflop is equal to 1 trillion floating point operations per second, whatever that means. I think that means it's very fast. And so if you look at the difference between the top part of that chart and where it says China, you can really see the advantage that the United States has in the AI revolution, even with the DeepSeek innovations, all that stuff. The U.S. is positioned tremendously to outperform there. And so any of these structural issues that we've been talking about, these headwinds, can be partly erased or mitigated or minimized by the advances in technology. And some of these people are saying AI is bigger than the internet. And if you think about how the internet changed our lives, so that's a positive. Robotics, you know, Tesla was going up at a tremendous clip, and then it sold off here recently. But I think one of the biggest reasons Tesla was going up wasn't cars; it was their robotics, and we're going to see some crazy stuff in the last couple of years coming out of China and Tesla and some other companies on robotics, and that's also not even talking about the AI thing. The whole medical technology breakthroughs that we're
Right.
going to see is going to be mind blowing. So
Yeah.
there's a lot of positives, but then back down to the Trump policies: lower taxes, lower regulations, lower energy costs. You've heard it over and over and over again. Regardless of what you think of his politics, those things, if executed on, will more than likely improve earnings for corporations, S&P 500 companies, and allow them to be more profitable, which will help stock prices. So,
And
so
put more money in the hands of consumers as well.
yeah. So there are some decent tailwinds. So, Dan, you want to cover this?
Yeah, let's talk a little bit about this. So again, I'm coming back to uncertainty in the market, lots of things going on. We don't know what's going to stick, what might be changed, or where we'll finally land. But that doesn't mean we just sit back and do nothing. So we have been doing some things. And here's some of the ideas and things we've been doing here for client portfolios in the last few months. We're looking at we've sold off, it's going to be a little bit about order. We sold off some interest rate risk, and we're keeping that cash in our dry powder stage where we can kind of take risk off the table, maybe keep it in some short-term money, short-term bond or money markets that are earning 4%. Be happy to earn 4% while I have it, while I kind of let things stabilize a little bit and before re-entering and increasing that risk back. That's been going on for probably a better part of a month and a half or so. You're probably seeing transactions if you're a client to that effect. The other part of it is when this has been going on, this is part of our natural course of our investment is proactive reallocation. We're not letting the appreciation of the last couple of years get ahead of us. We've been pulling allocations back to target where we can, while at the same time trying to balancing the tax ramifications of doing something like that. But we've been actively keeping an eye on that, not letting gains, like I said, the last couple of years get too out of hand.
I think we also, Dan, we had positioned the portfolio well ahead of this into areas with that we've been saying had more opportunity because the valuations were less. Now, granted, we were early. We're always going to be early, and and that includes going into international markets, value stocks, and things like that, which have had less volatility than the stuff that's been getting hammered about the last few weeks.
Yeah. It kind of goes back, 2 years ago, where we get questions of like, why are we having bonds? Why do we have international? They're not doing very well. We have those in there for this very reason, because at some point in time they will be, the bright parts of our portfolio, and will help kind of mitigate or minimize losses, as Mark said at the very beginning of this. In the other brights, yeah, go ahead.
Oh, I was going to say also, just in the save time here, alternative investments, we are going to be adding some securities in the alternative investments, which, higher yield, also non-correlation or hopefully a negative correlation to markets and things like that. By the way, our alternatives have done great over the last several years, including this year. And so when you take into account the outperformance, international stocks, bonds, alternative investments, that's why we've been minimizing losses, and we feel really good about how things are positioned right now. So you'll see some changes coming up in the near future, and that's why we're doing this. So
there's one other secret strategy to this that's not on this list, and that's patience. It's during these kind of volatile times, these uncertain times. Sometimes patience can be your best strategy. Don't make big changes. Big changes, all in changes don't work.
Yep.
You never can't time those right. And remember, diversification works. It's working now. It's working for you now. But be patient. And the patience part of it comes maybe has a couple of different ways of approaching it. But if you might want to look at your cash needs for the next year or two, and talk to your advisor, and maybe we make prepare for that if you have some expected large withdrawals you might need in the coming years. Get ahead of that now, and not until when you need the money.
Yep.
Okay.
Okay. Let's land this baby. One last slide. This is kind of fun.
Yeah.
Okay. Yeah, I don't expect you to read all this stuff, but if you just read the top, this is a chart. It says S&P 500 forward total return. So like I think a 1 year forward return after CNBC does their markets in turmoil special.
Right.
And because they always do it, and you can just see the number of times they've done it, what, 50 times or something like that. But if you take a look at the returns of the market 1 year later, then as soon as if you hear markets in turmoil, looks like things are going to get a lot more green for sure. So with that said, thank you. We didn't even come close to our 20 minutes. I'm sorry, but
I don't think we're that far.
It's a continued evolution for us. But anyway, please, if you have follow-up questions, feel free to email us or call us. And if you have any suggestions on any other information that you'd like us to cover in the future, we would love to hear about it. So with that said,
thank you.
Yeah, thank you very much. And
have a good day.
And have a great day. Okay. All right. Bye-bye.